How did a private investor go from zero to $200 million? I feel like this can be anyone because he was a clarinetist. He was a damn musician making a $55,000 salary. So how was this possible with no background experience? This is a good story to just highlight the effectiveness of investing on your own and doing the right things to guarantee your success in the market. So in this video, we're going to talk about Edward Avedisian. When Edward retired and gave away $100 million to the Boston University Medical School, people are like, what? How did he have so much money to give away as just a musician growing up poor in Rhode Island? So this was always astonishing. A professional money manager came up to him and asked him, how did you amass this money? He had over $200 million. So this is where the interview happened. He gave his advice on how he became successful. So we're going to go through some tips, some tricks, some things that he talked about in this interview. One habit that was essential for his success was living a stripped down lifestyle. Edward said that he didn't marry until he was 55. He never carried any debt, lacking any demands on his money. He put everything he could into the market on a $55,000 salary. To me, the risk was minimal. So at that time, the risk was very minimal. He didn't have any obligations. He didn't have a family. He didn't have any kids. So all that money he was saving and earning, he was just dumping that all into the market, making that money compound for him. So that's essential. If you were not saving, if you don't have any money to dump, to DCA, dollar cost average into the market, it's just going to be harder for you to get there if you're not earning a lot of money. So if you're earning less, this is essential for your success in the market. To strip down your lifestyle, dump the money that you save into the market, and just keep that compounding machine going. His second habit of success was actually reading 2 newspapers daily. He read the Wall Street Journal and he read Business Daily when he was on planes traveling as a musician. You have to keep up to date on just what's going on in the market or what's going on around you, just general information. Also, he was reading IPO prospectus, which is when a company goes public, lays out its own strengths and weaknesses, how much stock its executives own, and whether they are buyers or sellers of it. Anybody who's not studying these is a fool, he told me. You find out what the company is doing, who's running it, and especially who wants in and who wants out. I never liked companies where shareholders were selling. You want my money, but you are heading for the hills. All these kind of details are in the document. Those were the habits of success. Now we're going to get into the rules. So the first rule that Edward had was make concentrated bets on your high conviction stocks. When he did a lot of research and when he liked the company, he would make high conviction bets. He had less than a dozen companies in his portfolio, and he was looking to hold for decades and concentrate on these bets. And when he was doing this, remember, he was plowing all his money into these stocks that he had high conviction for. While saving money and putting every dollar you can is clearly important for me, one of my cardinal rules was owning a few great businesses that can grow for generations will generate you great wealth. The magic of compounding will see to that. Edward's second rule: stay calm, stay invested, keep your own counsel. This rule comes to fruition because people always think that market timing is so easy, and he gives an example at a cocktail party where people were talking about how they timed the market in 2022 or 2029, and he asked for their statement. Give me your brokerage statement. Let's see if you actually did this. Not a peep. People cannot give him that brokerage statement, and he never heard from them again. So when it comes to market timing, you can't do it. But the market always recovers, so he's saying stay invested. However, Edward managed his own portfolio actively. He wasn't a one decision stock kind of guy. Instead, he would plow more money into companies that were doing well, and he would sell those that were faltering. In other words, he paid attention to a business competitive advantage, whether it was waxing or waning, and enthusiastically agrees with Peter Lynch's mantra: water your flowers and cut your weeds. The third rule was use margin. I don't really like this rule and I don't recommend it, but this is what he did. Remember, he didn't have a lot of obligations, so he was actually able to borrow against his stocks, get that money from his brokerage, and put all that money back into the market. He used the stocks that he already owned as collateral for it. When his initial attempts were successful, he borrowed more. At one point, he had 13 brokerage accounts, mainly so he could maximize his allocation of IPO shares. but also to compare margin rates between them. The more assets I had, the more I could borrow, the lower the rate I had to pay. This is how Edward actually juiced his returns and got there faster than what he was expecting, because he did have a $55,000 salary at the time. So he used this margin just to juice his returns, but it could have went backwards if he did this the wrong way. So I don't recommend this. It's a hard thing to do. This is an easy way to go to zero on your accounts. So don't do this, in my opinion. Fourth rule, last but not least, you have to find a higher purpose. This resonates with me a lot because if I'm going to invest for the next 30, 40 years, I need to find a higher purpose in order to stay the course. And Edward invested for 40 years. So with that in mind, if you're a long-term investor, there's going to be so many highs, so many lows, so many times in the market where the market doesn't go anywhere for like 5 years or 6 years. What are you going to do? Are you just going to run away, run out of the market? Like, you just can't do that. You have to find something bigger than just the market. And for Edward, it was because it was fun. He enjoyed doing that. On top of that, he came from immigrant parents, so he had other people in mind when he was investing. He also wants to be that person who's able to help out other people. And that's why pretty much he's going to be donating all his money, always finding a way to help out other people. And you need that long-term view, that investor mindset, and having a higher purpose in order to do this. So to close it out, Edward never gave a list of the stocks that he owned. That would be amazing if he did, but he talked about owning household names that a lot of people owned. He owned a lot of technology stocks like Lotus, who invented the spreadsheet. He invested in Microsoft. He invested in a lot of IPO companies. Never owned any healthcare stocks because he just couldn't understand it. So he was keeping it to simple businesses that he could understand. During the interview, he talked about learning from Peter Lynch, learning from Warren Buffett, and all the great investors. Early on, the key to his investment success was to focus on the few critical variables in a business and how they might set up a company for a radical outperformance. And he gives an example of actually Bill Gates. He bundled Word, Excel, and other office productivity tools together in a single package. Make life easier, collect more money is how Edward described Microsoft's business strategy. And it's true, since its IPO of 1980-60, Edward began to invest. Microsoft had appreciated 2,400-fold, or a compounded rate of 24%, for more than a market average over that time. So guys, if you learned a lot, like this video, subscribe to my channel, and I'll be back in the next video. Peace!